All right. Good morning. Good morning, everybody. Hope you had a good weekend. So not a lot has changed from where we were to where we are. We have another bull trap gap up on SPY. And of course, we'll see how that follows through. Spot Gamma's founder's note points out that the put wall was rolled up. The call wall didn't move, so we'll have to see what comes out of that. And it's not rolled all the way back up to where it was. It's just up. If you look at the picture I shared, the put wall has higher lows and basically equal highs. And that's what we're working against at the moment. Russell's leading in the indexes. Europe negative. The Asian market's basically flat. And then our markets go up from about 0.25%. There's always that little tell, right? When small caps are leading and the other indexes are nearly equal. It won't stay like this, so the market's looking for a shift or a catalyst. It's very likely not going to be the leading economic indicators, especially since the numbers aren't that far apart. We do have auctions today in the later part, so 11:30, the front end, so you could probably just chart them with IRX. The Japanese Prime Minister failed again. I don't know if again is the right word, but he failed in the election. Not sure what you're talking about. Failed. I didn't share anything. I don't share it over the weekend if that's what you're asking. Spot Gamma doesn't share over the weekend, and I'm certainly not going to go to the office just to share Spot Gamma's notes. Yeah. Just scrolling back, I sure see that I shared Spot Gamma's founders notes last Thursday and Friday. So keep your eye on Japan. This anytime a leader says I'm not leaving, right? It's something to pay attention to. And I work 12-hour days in the office, guys. I'm not coming in on the weekend. Ain't happening. I'm in here Monday through Friday, 12 hours a day. So now we got the put wall rolled up. It's above 6,100. So it's a little bit closer, still a long ways off, all things considered. We'd need to break the volatility trigger, 0 gamma, 10-day, 20-day, 10-week, 3-week. We would need to break all of that structure to get to the put wall. And while technically that's possible, the idea would be if we did break that much, the put wall is not going to help us, right? Because it would be such a catalyst that whatever sent us south in the first place would be too strong and it wouldn't care that the put wall was there at all, right? Otherwise, working lower from here, we've got a lot of levels that we can hit on the way down. And it's choppy and violent, nasty. This doesn't really show that fake out the way that SPY does, mostly because of the overnight hours and what it considers close and not close. So if you're on Thinkorswim and you kind of want to see that visual anyways, just go to the gear icon, go to futures and remove show extended hours. And now you'll see how we had that fake out It shows it a little bit better now anyways. So close here, open up here, and we had that loop-a-doop last week. Close here, open here. Not much of a run to the upside on that one, and then shot down. So that one made contact with the 3-period moving average or came close enough, and then we had that rally back up. The thing about the rally back up is the midpoint, and the fact that we didn't, close above that midpoint. It's not good. So this morning, sure, we're continuing that drive back up, but we're stalled out against the RTH of Friday, the RTH highs. It's not the entire high of Friday, but it is the regular trading session high. That's what we're hitting on right now. And if you look at SPY, now TradingView had a better image of it. It shows this morning. Thinkorswim never really does that good of a job with showing pre-market moves, which is why we always show spot gamma in the mornings and TrendSpider. So we can see on TrendSpider, it's already got this morning's little gap up. It's looking like another fake break like we had here and there. So we'll see how it turns out. But at the moment, this is just another fake out. The thing is, we've been in this range for a while building out levels, and all those guardrails or levels or bumpers or whatever you want to call them, now that we're through with OPEX, they're gone. And we don't know if we have new levels in place or if they're just gone and we're going to be able to move through there. My concern at this point is what we call a raid and a draw, right? So it's kind of a older phrase. I don't think it's really all that popular in logic anymore, but I still like it. When you have a sideways market, we call that a draw because it draws everybody in. Shorts can get in here, longs can get in here, and you never quite know if you're wrong yet because we're still in the box, right? So generically speaking, if you're short, you would be putting all your stops up here. And if you're long, you'd be putting all your stops down here. And both sides think they're right, so they can get in. It draws everybody in. So we call it a raid and a draw. Once we've got the draw, oftentimes we will raid liquidity on one side and then run it on the other side. I don't know if that's what we're going to get, but so far that's what it's setting up for. So raid and a draw. So keep your eye on this. If we do get a fake out, then the target, of course, is just going to be to break down through the previous levels, the midpoint, half back, through the lows, and then out the bottom side. And, if you want to just use moving averages, you can do that. You got the 3, the 10, target the 20. And if you're taking swings, then 20 should be your first blush, and the 50 should be your second shot. We just don't have any reason to believe that we're going in that direction. So if you're going to go short, you're going to want a really good reason. The ADRs this morning, since we moved closer to the upper edge, then base case argument is that we could hit the upper edge first. But to hit either side, we would need an inside day breakout, right? We would need to get outside of yesterday's trading session to hit either one. But it's obvious that we're closer to the upside than we are the downside, and that makes it more likely that we hit the upper one first rather than the lower one. The thing is, if it's going to be a sideways day or a range day, we don't have to hit either one. We can just stay right here chopping around in the middle of them. That's the RTH mid of yesterday. And you can use that or just use the entire thing. I generally start with the smallest range first. And then if we break those levels, then I go to the next wider range. It has shown absolutely no respect at 63.50. So I wouldn't look for that level to provide any insight, at least on the ES. Then we get over to the SPX, that'll be a different, whole different conversation. All right, so on Thursday we had that MDP, and on Friday, at least during the morning briefing, we still had an MDP, but we did hit it Friday afternoon. So we lost our consecutive count status on those missed daily briefings. So now we are opening above the weekly pivot. That puts us in a bullish bias. Compared to last week's channel, this week's is pretty wide. A wide channel implies that even if we do break out on the week, it likely doesn't stick. But we're talking about a weekly breakout. So you'd want to go to a weekly chart, measure last week's high and last week's low, and look for price to break out of that range. And this says that if we do that, it likely doesn't stick and we come back in. Today's floor pivot is higher than yesterday's. That's bullish. Price opened underneath it, and that's bearish. Those two kind of cancel each other out. Today's floor pivot channel is narrower than Friday's, a lot narrower, but it's not as narrow as it could be. They could be so narrow, all you see is a purple line. A narrow channel implies that if we break out, that it can run. Like last week's really narrow channel says that if we break out, we could run. And sure, at the end of the week, we did break out, right? On Thursday. Actually, I don't think we broke out of the previous week's range last week. And if we did, it was a fake out and we came back in again. Yeah. We faked out both sides, came back in. So now with a wider channel this week, if we break out on the weekly, it's even less likely to stick, and then we come back in. Just keep in mind that these channels don't make price do anything. We are already at R1 and stalled out. We've been unable to get above it. Of course, if we can get above that level, it opens R2. But generally, if you get to an R1 like this, or if it was the other way around and we had gotten to the S1, then what we line up for is R1 S2 or S1 R2. I get it. There's a lot of lines here, and that can seem a little confusing. Here's the floor pivot. Here's R1. This is S2. The strategy is that if you get to an R1 and you can't get through it, generally speaking, you can run to S2 or flip the whole thing over. If we had gotten to the S1, then we could run to an R2. This is what markets do, right? You get the pullback, the lower high, the new lower low, the new pullback with a lower high, and then the next run with a new lower low. This is basic market logic 101. So we're at the R1. It does not say that we have to go to the S2. That would just line us up with what we've been working with already. If we can break the R1, get through Friday's high, the target is R2. We can see the distribution that we left behind last week. We put in a lot of work going into the close there too. And since then, this week, obviously we haven't been open very long. We haven't put much work in here, but we've seen more work closer to Friday's high and all this work right here. And it's that 63.50 area. So we want to keep an eye on that zone, especially once we get into the open. And the volume came in a little light, 40,000. We've been running in the 50s. So seeing 40 just suggests, we're a bit light. I didn't check to see if there was nations closed, but that's one of the tells that I use, right? Because going in and checking every day to see if nations around the world are open or if they had a banking holiday or if they're sitting out because of some economic event that they're worried about. Doing it every day is just tedious. If you check the volume overnight liquidity like this and it comes in light, then it tells you, hey, they were either sitting out waiting on something or we had an overnight market that was closed. This looks a bit light, so it probably wouldn't hurt to check if there was a market that was closed due to a banking holiday or what other reason. The best place I found to check that is tradinghours.com. It's free. It's really accurate and it has the time zones for those markets so you don't have to guess, right? And it checks their holiday schedule, their banking schedule, their economic calendar, and that's the way to go, right? So I think you can get an account here. I don't have one. I've never had a reason to get one, but you can see all the markets from here. So it's generally the way I go. Either way, that volume looks a bit light. So if there wasn't a market closed, then we're seeing a lack of participation while they wait on something. And of course, that leads us back to, well, what the heck are they waiting on? Ten-day, 30-minute volume profile with TPO, that 63.32 cog line really has grown out since we were here last week. When we do see the point of control move, that's very likely where it's going to end up, 63.32 cog line. Unless we just cut right through that and start rebuilding this 6,300 zone, which, we could do that. If we don't revisit that 6,300, then by default, it will eventually go to the 32 cog anyways. I think the TPO's got a better representation of all of this right now than the volume profile, just because this high volume node really shifts the distribution profile, but it's where we're at right now. And this point of control is not likely to move anytime soon, right? We've got at least a week before we even get to the candles, which would be what, like probably Thursday or Friday, maybe that Monday afternoon when we really put in a lot of work around that 6,300 area. So there's just a lot of work here to unwind. We still have that VPOC from 6283, so we'll keep that on the radar if we happen to go that far this week. We don't have a new VPOC from Friday because after we opened, we cut through that first to the downside and then we ran right back up through it. So for me, I'm not marking out this volume profile, but the textbooks will tell you to do that, right? So that in case we trade to the downside today, we would be watching that level, which happens to be no kidding 63.32 cog line. It's Friday's point of control. So I would already be watching that level anyways, simply because it's a cog line area. I love how that works out. Little discrepancy between the TPO and the volume profile this morning, but we're putting in a lot of work across this low here. It's almost there, but there is a discrepancy. We got the point of control on the TPO at 42, which is an old cog line. And then we've got the point of control on the volume profile at 63.50. So last week we were evaluating the size of this box and comparing it with last week. The size of this range is based on time and volatility. We can have a 5-day week, a 4-day week. We can even have a 3.5-day week. So how much time we have each week could vary. But last week was a 5-day week, and this week is a 5-day week. So we know that the times don't vary. The only other thing that could vary to make these wider or less wide would be volatility, because those are the two ingredients, time and volatility. The current week in its width looks really similar to the week that we just finished. If it was really narrow or if it was really big, that would stand out and give us some indication that the markets, were sitting out or pricing in something. But at this point, we don't have anything. It's just the same as what we had. On the one hand, we had OPEX last week, sort of suppressing volatility and making everybody talk about that range that we were in and how it was going to be very difficult to get through. It's a little odd that this week has the same expected move as last week because we don't have OPEX anymore. So what's the suppressor that's holding us back this week? I don't know. I don't know. I know we're getting close to the end of the month, but that's too far away yet, right? Because we got QRA on the 28th, part 2 of QRA on the 30th, with FOMC on the 30th, and then the tariffs start on the 1st. All that's coming next week, but that's not this week, and that shouldn't be a suppressor for this week. I don't know. We're still 3.25% above the 10-week, so we're fine, and we're easing our way back the way that we should. So there's just nothing wrong here, right? Everything's fine. Looking at it from the daily, we came back up off of that low. So we got down to the 10 and we moved away from it, and we're just holding within this zone. And holding within that zone means we're just fine. We're not breaking down, getting ugly, selling off a long distance below the 10. We're just sitting in a really good spot. Market is calm, it's safe, it's healthy, it's not overbought, not overextended. It hasn't moved too far, too fast, and it doesn't owe us anything at this point. This is just a really calm distance from the 10. We got nothing. Still got that capital rotation going on. If you look at the breakouts on here, technology with breakouts, industrials up there for a breakout, and utilities breakout with it on a wedge, but still a breakout. And that just makes me think of the data centers, right? Now, the data centers, I'd really expect more out of consumer discretionary to kind of go with it. But that's all we've got. And it is odd to see staples starting to curve that white line higher, the linear regression line. It's not curved as much as, say, finance or tech, consumer discretionary. Our top three are risk on, but it is starting to curl to the upside. We've got the upsloping 200, the 50 is just holding strong up there, as opposed to something like healthcare, right? It's pointed down, 50s under the 200 with price under both. It's just a really bearish distribution and perspective and bias. Staples coming around slowly, getting a bit of a capital rotation. There was quite a bit of Staples news over the weekend, right? About the red dye and companies that are trying to fast track the removal of those dyes. Kennedy's been going after them, right? So looking at things that are down this morning, we really don't have anything other than nat gas. And I mean, it's a joke anyway, so who cares about nat gas? Flip it around the other direction. We got communications, quantum, Bitcoin, airlines, Bitcoin again, and then again. Mag 7 up volume, which is just a double positive. It's kind of weird. Bonds, precious metals, China, uranium. I mean, really, we got just about everything. We have the Mag 7, just not enough, right? We need a 0.5%, but we've got the Mag 7 up volume. It's a good start. And we got China, but not all of the China, right? We don't have MCHI and EEM. Technically, EEM is not China, but I mean, as emerging markets go, they dominate that ETF, so it might as well just be China. And obviously, what we don't have and would really help out would be chips. Yeah, it says Bitcoin's up, but we've been playing this range now for a few days, and we're not trying to break the range this morning. We're headed away from it. So I wouldn't even focus on Bitcoin at this point, unless it can GTFO, right? Get out the box. Precious metal likely looks, well, I was going to say likely looks a little bit better, but that just looks stretched. I don't put a lot of weight into those sort of fake outs early in the morning. The range is clear though on the daily. So if we can get through that 310, kind of continue to push to the upside, use this spinner bar here, whatever they call that bar. Nice spinner, but it's not a spinner because the wicks are too big, but we'll gotta call it something. This bar right here, this is July 16th. Use the high and the low in the mid of that bar. If we can get through the top of that, I'd like to say we could get to 312, but look at all that selling back here. And every time we've tried to get into it, they've been selling out of it, right? They were selling at 12, now they're selling at 10. I'd be surprised if we can even get through that 310, right? So be watching this for a really nice reversal here. Just be mindful, that it's a violent, gappy mess. And if we can get through that spinner bar, then we can revisit 312 and then 315. It's surprising to see the Mag 7 even up this morning with Microsoft getting whacked in the news, right? They had some kind of vulnerability getting exploited by hackers this morning in a coordinated, concentrated effort. And the stock didn't like that. It was down a little bit. And I mean, looking at what's down, we don't have anything down yet. So you want to see a significant change to the program, something really negative or really positive to get us out of this box. And that's where we're at right now. That's what we're stuck with. We don't have any economic events today big enough to get us out of the box. And we don't have the sectors or the industries or the stock names, the right ones that can get us out of that box this morning. So it could be 0-day flows after the open, maybe some dealer GEX and hedging dynamics that could get us out of this after the open, or just some headlines, right? After 9:30, just some tweets or something that can get us out. But otherwise, what we're running with right now, we don't have the juice to get out of this range. So look for the catalyst. Otherwise, expect a range day. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.